Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is December 28th, final edition for 2014 of Market Outlook. Don't forget to go to www.marketgauge.com and sign up for this video newsletter. So, how are we shaping up for 2014? Well, the Santa Claus rally's in. Market's at all-time highs. Let's take a look at some of the action. As you can see, number one, looking pretty good. Market basically closed on new highs. Now, the one thing to be a little bit cautious about is the fact that we basically closed with a doji day, and even though we took out all-time highs that had been sitting there for some months now, the market has not been able to really propel much higher. Now, this could just be a pause because it's right around the Christmas holiday. Market participants are largely on vacation. So definitely need to watch this most recent price action here. We really want to see the market hold the last 4 or 5 days of action. Critical support really comes in around the gap that was created, which was about 204 or actually, let's see what the exact price is. Yeah, somewhere around this 10-day moving average, or just a little bit under it, which would be around the 203.70 level or so. So that's your critical level. Obviously, the last 3 days, not quite as critical as holding that gap, but we definitely want to see this thing hold around the 207.50 level as well. Other than that, market is in gear. Let's take a look at IWM, which has been the big concern all year about how the small to mid-cap stocks have not performed in sync with the rest of the market. And basically what you have is massive consolidation going back to the end or the winter of 2013 all through 2014, and we're basically at, although I don't believe we've got a new closing high for IWM, maybe just about. So we really want to watch this IWM, because with this type of compression, the power of moving off of this move or getting through new highs could be extreme. Now, not excessively overbought, so potentially a lot of power there. Now, on the flip side, you definitely want to see this market hold that gap, which comes in right around the 10-day moving average, which is 117.50 or so. So there's your critical level of support. If we can't manage to hold that level there, potentially yet another attempt at the highs failing, that would be a lead indicator that the market may have run into some trouble. So again, overall price momentum still very positive, just pointing out some potential negatives, which is that short-term spiky pattern in the S&P. Let's take a look at the market sentiment. The VIX, as you can see, interesting, we're trading right now in the midpoint of the Bollinger Band, right on the 200-day moving average. Now, interesting, as the market, the S&P, has been moving to new highs, we have still been holding well above the lows put in back in early December of this year. So a little caution here that the market's signaling as we move to the end of the year. So actually that could be perceived as a positive, as we're just trading in the middle of the range, again under the 50, holding the 200, but still a little bit of concern in the market relative to the more recent highs back in December before the sell-off. So that is interesting to note. On the flip side, you could say that there is still some concern from a sentiment standpoint Hence, we're holding that 50-day moving average, excuse me, the 200-day moving average, which could signal that some of the participants here are concerned as the market hits new highs. I, for one, am a little bit more friendly to the market. We're basically trading under the 50-day and inside the Bollinger Bands. So again, to me, this is pretty normal action, and it doesn't show irrational exuberance at this point. Let's take a look at, I want to take a look at the ratio. This is the ratio between short-term volatility, 1 month out, and 3 months. This is generally a pretty good indicator. As you can see, if we get above this 125 level, 1.25, it's definitely a cautionary area in terms of irrational exuberance. At this point, we're not even close to there, although we are trading above 1, which at some time in the past, once we get above 1 and trade back under this green line moving average, often signals a warning and a potential sell-off coming, but meanwhile, we're nowhere there. Again, overbought, up around 125 for sure, and around the 0.95 to 1 is a bullish indication, and that has generally been a great level to get long on those sharp V-bottom sell-offs. So right now, this is not indicating anything, maybe running a little bit rich, but not very much. So not much you can infer from that. Okay, let's take a look at a couple of other stocks. Let's take a look at, first of all, USO, oil. As you can see, oil, as in the U.S. oil fund, has dropped from, around 38 all the way down to 20. Massive drop. What we really want to see in this here is if we can get a close above 22.50, that would signal a potential pause and a reversal pattern in the oil market. Otherwise, the close on Friday was pretty dismal. There seems to be no real good news for bulls in the oil market. The close on Friday was one of the, just about touching the absolute low close of the move. So no help there for oil bulls. I would definitely reconsider around the 22.50 level, at least on a short-term basis. Let's take a look at the Russian stock market here. Russian stock market, RSX, was trading also above 28, has really collapsed down to under 14. Got a bit of a rebound with the Russian central bank trying to stem the tide, both in the currency and in the stock market. You've got some nice gaps, as you can see in here. If we can start trading and stabilizing above the 1675 level, it could signal that a temporary panic is over with in the Russian stock market. So this whole move down from this piece here and this potential bottom formation here would be confirmed with a close above 1680 to 17. So 1680 to the 17 level. So other than that, market's still in a free fall. But again, stable. The stabilization here would be obvious with a close above that 1680 level. So that's it for Russia and the oil markets as well. A couple of other things to note. The inflation-deflation indicator that we often watch. Gold has definitely still way underperformed the bonds. bonds, as you can see, even with the recent correction off the panic highs here, overall the inflation deflation indicator is leaning towards deflationary expectations, certainly when compared to U.S. bonds, and this is a pretty good indicator. So interesting to note that as well, although we have come off from the highs. Taking a look at interest rates, a little bit more on junk bonds, which has a lot of oil patch debt in it. As you can see, quite a bit of panic just in the last couple of weeks, along with the collapse in oil prices. The key level to watch here to know that the oil crisis potential debt default here is abating would be a move above the cyan line, and that would take place around 39.50, where you can say the flush in junk debt has occurred. Meanwhile, the panic and the potential free fall is still on. So 39.50 would definitely get you back above some key levels before this broke really hard, and above this pretty well defined moving average, which has contained the rallies for the past 6 months or so. So that covers some other pieces of the puzzle regarding the oil shock drop. Let's take a look at some commodity prices as well. And we looked at oil before. Two commodities to take notice of. One is cotton. Cotton tried to get above its moving average, has been bottoming out. These prices are pretty low. We tried to take out 42.50, which is the critical moving average level, and couldn't quite hold on Friday. So again, any close above 42.50 compared to other commodities, this cotton is definitely one of the more interesting ones and potentially in the process of bottoming. And this is, just want to remind you, a weekly chart, so this is a bit of a longer term perspective than what we normally look at. Another commodity to keep an eye on is corn. Interestingly enough, corn is the only commodity that has really shown signs of bottoming, and in fact has moved nicely off of its lows, well above its moving average, which has now turned positive. So if we can get any type of correction in this, we'll be a buyer of corn in the coming weeks as well. Looking at interest rates, once again, just want to point out one other thing, which is BND, which is the Vanguard Bond Fund. And one of the things you can see is that the bond fund, which is an assortment of all different types of interest rate instruments, has already started to break down. Now, when you compare this to the U.S. long bond, which is strictly the 20-year bond, quite a different tale, right? Look at the same moving averages. Market is still well intact. So, as certain areas of the world flock to U.S. instruments and try to lock in even the low rates that we have, they still looking at it as a safe haven. So U.S. bonds, still very strong, trend intact. But what I do want to point out is that there is this potential. Look at this high over here and this high over here on the charts. And actually we made a new one by just a few ticks and have sold off. If we can trade under the 121.50 level or so, a little bit under the 121.85, which is this moving average here, it could signal a potential top in U.S. bonds as well. However, until that occurs, trend is intact. So long bonds, U.S. long bonds, extremely powerful relative to the interest rate complex, the rest of the interest rate complex, especially junk bonds and emerging market debt as well. Okay, so that's it for now. I think it gives you a pretty good overview of the U.S. equity markets, some of the oil patch, Russia, and some of the market internals. Again, looking at the market internals at this point in time, which is year end, it's a little sketchy because of the low volume and potential false readings. So less inclined to put as much weight on it as I normally do through the rest of the year. But meanwhile, trends for the U.S. equity markets well intact. We got those critical levels. A little sketchy action, but that could be, again, end of the year activity with that sort of doji day in the S&P, which we have defined critical areas to watch for on a potential sell-off. Well, listen, I want to wish everybody a happy, healthy, and profitable new year, and look forward to seeing a lot of you all next year. And bye for now. And again, Happy New Year from Market Gauge and the whole team.